Hey guys, Josh again here. Today's topic for some financial tips for you is going to be withdrawing funds from retirement accounts and taxable accounts. So let's start off with the taxable accounts first. Every scenario is a little different, so I can't put a blanket statement across the board. But let's just say any sort of brokerage or retail account that you have that you're doing some investing, or maybe somebody's helping you, whatever the case is. Most of the time, pretty much as long as you have gains in the account, you are going to be taxed on your funds that you withdraw or that you sell. So when you're looking at funds, the main things you want to focus on are one, brokerage accounts or retail accounts. They have no limits. You can put in whatever you want. Put in $50 a month. You can put in $500,000 at one time. It's not like a retirement account. We have contribution limits. And it's free flowing money. You can sell things. You can buy things. Now, there are different taxes with that, which I'll explain in a second. But there are different ways that you can look at that for maximizing your tax benefits. I'm not going to go into specific recommendations, but I'll give you some ideas about how those work. So the first thing is with the taxable account, what you want to think about is, let's just say you put in $10,000, okay? And let's just make up a stock here. You bought Apple, and Apple turned into $5,000 over a year. There are differences for selling these things. So if you sell your initial $10,000, you're not going to get taxed on that because that's money you already were taxed on. But the $5,000, you will have taxes on only the gains of what you've made. So the $5,000 over the $15,000 total, you invested $10,000. You now have taxable taxes that you're going to have to pay on $5,000 worth of gains. Now, depending on the type and how long you hold it, will depend on how much you need to pay for taxes. So there's two different ways to think about it. One, first way to think about it is short-term gains. Anything held less than 1 year is going to be what's called short-term gains. So on that, again, the $10,000 that you invested originally, never taxed again. But on the $5,000 of gains in this scenario, you will then have, let's say for short-term, you held it less than a year, you sold it. You're going to be taxed at your tax rate, it's called short-term capital gains, and they're taxed at whatever your bracket is. So you're going to maybe 20% or 24% or whatever the tax bracket is for you. If you hold it for 1 day and 1 year, it is then considered long-term gains. One thing, long-term investing is usually everybody's best benefit, but the advantage to that is significantly lower taxes on that $5,000. Because instead of you paying, 20, 25, 30%, whatever your bracket is, right now, as of today, I think the long-term capital gains rate is 15%. So in this scenario, you're only paying 15% of that amount of money on the $5,000 that you made from the account. So when we're looking at the whole aspect of investing for short and long term, if you need the money, of course, sell it. You're going to be taxed a little more usually on any gains. Long term, you're only taxed at about 15% for your gains that you have in the account. You keep the rest of the money. So the advantage of that there is then you will be keeping more in your pocket because you're not going to be paying as much in taxes. So as an example, let's do some math here. Let's say on that $5,000, you had on the gains you made, say, you were at the 25% tax bracket. You're paying $1,250 in taxes. So out of the $15,000 total, you're only getting $13,750. Now, let's say on that $5,000 you did long term and you held it for a day and a year or 5 years, whatever it is after 1 day or 1 year and 1 day. 15%, you only owe $750 in taxes. So that's going to be keeping you $14,250 in your pocket. So long-term capital gains are more beneficial than the short term and trying to buy and sell because one, again, the amount you're paying to the government and taxes is less. But two, you're not trying to time the markets and trying to be a guru investor, which pretty much nobody is. And the other thing now that leads into this is short or losses that you can actually use. So let's say in that same scenario, you invested $10,000, but it's now down to $7,000 because you lost money and you held it for a year, let's say. In that scenario, you have a $3,000 loss. I understand that it's not fun to lose money, but you need that $7,000, you sell it. The one advantage to that is when you sell it, you actually can declare those losses against your taxes to help for any future gains, things like that. And you can use, I think as of 2023, you can do up to $3,000 per year. Now, let's say you lost $6,000, but you needed the $4,000 left from the $10,000 investment. You could only declare $3,000 this year for the losses. But another advantage of the losses, although they're not great for you as the investor-wise, you can carry losses forward. So you can keep carrying $3,000 per year forward as long as you can, in case you're making a bunch of money other places, and maybe you were in a jam is the reason you sold. But you can carry those losses forward into future tax years. So that highlights the taxable accounts. Now, retirement accounts. There's a bunch of different avenues you can take here. Let's say, though, just your normal ones. I talked a little bit about it in a previous video, Roth IRA withdrawals. You can take out contributions at any age because you already were taxed on that money. It was already funded with after-tax dollars. So you can take out your contributions, no taxes and penalties. Now, if you're taking out your gains in the account before 59.5, that is going to have some penalties as well. There's going to be a 10% penalty, and you will be taxed on the money because of the fact that you're taking out the gains before your 59.5 age. An IRA is similar. You can't take out those contributions. Those will be, they'll always be taxed. They're added onto your income, number one. So let's say you took out $5,000 from an IRA, you made $10,000 that year of income. Now looks to the government like you made $15,000 that year. So it could increase your tax bracket. But, and the big downside to that, again, the IRA part, and this is the same with the 401k and 403bs and other things, but I'll go into that in a second. The other thing is with the IRA is that not only is it added onto your income, but you're penalized 10% for taking out the funds because the government's trying to dissuade you from taking out your retirement money before your retirement. That's another reason why I like the Roth IRA over IRAs if you can contribute, because of the fact that you do get some leniency there with some withdrawals without penalties and taxes. Now, similar, one other thing about the IRA is you also, in one time per year, you have a 60-day window to put the money back to avoid taxes and penalties. So let's say you take out $5,000, you needed it for whatever, buying a car, and you got a check for $5,000. You can add those funds back to your account, your IRA, within 60 days, and you will not be penalized or taxed. It's almost like a loan you're taking. Now, 401ks, 403bs, those type of accounts have a couple different avenues you can take. One, you can take out funds if you need to. First-time home buyers can do up to $10,000. Yes, it's always added onto your income if it's the traditional 401k. But there are also avenues that avenue for a couple medical expense things, first-time home buyers. There's a couple of other things you can look up online, but there are no taxes and no penalties. You're pretty much loaning the money to yourself because let's just say, for instance, you take out the $10,000, you put it on a home, and you did a payment time frame of 5 years back to yourself. Your company will take out an amount of money every 2 weeks or every month, whatever you plan it as, over 5 years. And let's say whatever the interest is, 4 or 5%. The advantage of that is you're pretty much borrowing from yourself because you're paying yourself back through your paychecks, and the interest that is charging is only going back to you. So if you do any kind of loan or withdraw from a 401k and you make a plan to do it, it's not a bad avenue to take if you're really in a jam. But if you take out the funds and it's not for a home purchase or it's not for medical expenses or a couple other things that you're able to avoid taxes for, anytime you take out those funds, they are going to be added onto your income, and there will be a penalty associated with it, the 10% penalty. So you want to watch out, you want to avoid that the best you can because, one, you're hurting your own retirement chances, but two, you don't want to be charged that penalty. That's your own money you've been saving. One last thing for you for contributions-wise, not only withdrawals but contributions, a lot of companies now are offering what are called 401k Roth. You can start contributing after-tax dollars to your 401k and having that grow after tax for the long term because you can also take out those funds, your contributions, without any penalties, any taxes. The gains are a little different, but the contributions are not because that's your money. You've already been taxed on it. So maybe look at your HR company, talk to one of your reps, think about a Roth 401k, traditional 401ks, 403bs. They're offering both pre-tax money and after-tax money. which is the Roth version. Just for instance, I'll just give you an example. When I used to work at Fidelity, I used to do 5% pre-tax, 5% Roth. I would do both at the same time, trying to maximize my retirement savings the best I could. So I had before tax dollars and after tax dollars. Now, the one advantage of the traditional 401 or the pre-tax money is every time you contribute, you're deducting income from your overall year. So as an example, let's say you made $50,000 last year and you contributed $10,000 to the pre-tax money or the pre-tax Roth or 401k. Now it only looks to the government like you contributed or you only made $40,000, so your tax bracket's lower. That's number one. Number two, anytime your company offers you a match on your 401k, you want to do that. You want to get free money. Let's just say your company gives you 5%. You contribute 5, they match 5. That's 100% return on your money every 2 weeks. There is no better deal than that. Max it out to that number the best you can. If you can go over, there's other ways you can look at investing, like a retail account or a Roth IRA or whatever it may be. But when you're looking at it from that avenue, max it out to the contribution match, at least from your company. Because again, is it 100% return on your money? You want to take advantage of that. I hope you find this helpful. If there's other tips and things you need, put them in the comments there. I'll answer it as quick as I can. Take care, everybody.